So you just paid a lawyer like thousands of dollars to draft this flawless, airtight will.
Right, you think you're totally set.
Exactly. You spell out exactly who gets the house, who gets the savings, the family heirlooms. You feel like you've completely secured your family's future.
But what's fascinating here is that a single dusty piece of paper you signed maybe 10 years ago could legally override every single word of that will.
It is wild. And welcome to the deep dive, everyone. Our mission today is to unpack this massive, often ignored aspect of financial planning, which is beneficiaries.
It really is one of the most misunderstood realities in personal finance. We assume the will is the final word, you know.
Yeah, that's the default assumption. We're pulling our insights today from some great educational materials created by Gruene Insurance Group. That's a family-run agency led by John and Mariana Levis.
And their core message really flips traditional estate planning on its head. They point out that your will does not automatically protect your family.
Right, because a beneficiary designation actually overrides a will.
Exactly. To understand why, you have to look at the legal mechanisms. A will is essentially a set of instructions you leave for a probate court.
And probate is where the judge comes in, right?
Right. It's the legal process where a judge verifies your will, pays off your debts, and distributes your assets. But probate is incredibly slow.
Oh, and expensive.
Very expensive. Plus, it makes your entire financial life a matter of public record. Anyone can go to the courthouse and see exactly what you left behind.
Wow, so anyone can just look that up. But a beneficiary designation avoids all of that.
Completely. Because it's a direct contract with a financial institution, it bypasses probate entirely. The money goes straight to the person named on the form.
Okay, let's unpack this with a sort of analogy. Think of your will like a detailed map you drew for your family's financial journey.
I like that.
But the beneficiary designation is like a teleportation device. The teleportation device activates instantly, ignoring the map entirely.
That is the perfect way to visualize it.
Like the bouncer at the bank doesn't care about the map you left for the judge. He only cares whose name is on the teleportation VIP list.
Right, and because the bouncer only follows that VIP list, we see these devastating real-world scenarios play out all the time.
Yeah, the materials highlight a couple of nightmare scenarios. Like, imagine someone buys a policy in their early 20s. They're single, so they logically name their parents.
Makes total sense at the time.
Totally. But fast forward 20 years. This person is married, they have 3 kids, and tragically, they pass away. But they never updated that original paperwork.
And under the law, the insurance company has absolutely no choice.
The spouse and kids get nothing.
Nothing. The parents get every single penny.
That is just brutal. And there's another scenario here. A client divorces, remarries, blends a family, but leaves an old 401k in their ex-spouse's name.
Oh, yeah, we see that a lot.
And so the ex gets the money, and the new spouse has zero legal claim to it, even if the brand new will says otherwise.
And these aren't rare edge cases. They happen constantly because of human nature. We tend to treat financial paperwork as like a one-and-done task.
Check the box at HR and forget about it.
Exactly. We don't view these designations as living documents. But since we know the wrong name can cause a disaster, we really need to understand exactly who we're allowed to name.
Right. Let's go over the cast of characters in your policy. First in line is your primary beneficiary.
And you don't have to pick just one person for that. You can name multiple primaries and split the payout by percentages, like 50-50 or whatever.
Got it. And then there's the contingent beneficiary, which is essentially the secondary backup plan.
Right. And you also have revocable versus irrevocable beneficiaries.
What's the difference there?
Well, most are revocable, meaning you can change them anytime. But irrevocable requires the beneficiary's written consent to change it. You usually see that pop up in, like, divorce settlements.
Okay, that makes sense.
Oh.
But wait, let me push back on the contingent thing for a second.
Sure.
Let's say I'm splitting my primary beneficiary percentage among 3 people.
Yeah.
And one of them is just terribly irresponsible with money.
Okay.
Couldn't I just make the responsible ones the primary beneficiaries and make the irresponsible one a contingent beneficiary, like to teach them a lesson?
No, that's a huge misconception. If we connect this to the bigger picture, a contingent beneficiary only receives the funds if the primary has already passed away.
Oh, really?
Yeah, it's not a disciplinary tool. If your primary beneficiaries are alive, they get the money. The contingent gets nothing.
So making them contingent does nothing to protect the money from their bad habits.
Right. And honestly, skipping the contingent beneficiary altogether is one of the most frequent and dangerous oversights people make.
Because if the primary dies before you, and you have no backup.
The teleportation device breaks, the money dumps right back into your estate, and you're stuck in probate court.
Yikes. Okay, but what if the person you want to name is a child?
Oh, this introduces a massive legal trap.
Yeah, the text is super clear about this. You absolutely cannot name minor children directly. Legally, children cannot receive life insurance proceeds.
Right, because a minor can't sign a contract. So if you name a 7-year-old, the court has to step in.
And the court appoints a guardian for the money.
Exactly. It becomes a slow, costly process entirely out of your family's control. A judge who doesn't know your family is suddenly making financial decisions.
And draining the funds with legal fees along the way.
Right. The correct move is naming a trust or a trusted guardian to manage the funds until the child is older.
So basically, life changes, so your paperwork has to change. The materials give a really good checklist for trigger events that mean you must review your documents.
Marriage and divorce are the big ones.
Birth or adoption, obviously. Also, if a named beneficiary dies. Oh, and here's a subtle one when a child turns 18.
That's a huge one, because once they're an adult, they can legally receive the money, so you might not need that trust structure anymore.
Or, any major financial changes. Or just simply every 3 to 5 years.
You really have to stay on top of it.
Which means we need to ask you, the listener, right now, when was the last time you checked your designations?
Seriously, think about it.
Have you had a major life event since you started your current job? It's so easy to overlook.
Now that we know who to name and when to update it, we should probably talk about the actual vehicles carrying this money.
You mean life insurance and annuities?
Yeah.
Let's start with life insurance perks. Why are they structured to bypass the will in the first place?
Well, the benefits are huge. First off, life insurance payouts are generally tax-free.
Which is massive.
Yeah. And as we mentioned, they bypass probate, getting money to your family way faster than estate assets caught up in court. Plus, they remain private.
So nobody can snoop on your family's inheritance.
Exactly. Unlike estate assets, which become public record.
Now, the source mentions term life, which covers you for a specific period of time, and permanent options, like whole and universal life, which last your lifetime and build cash value.
Right. Those are your two main life insurance buckets.
But then we have annuities. And an annuity is basically a steady stream of guaranteed retirement income that you can't outlive.
Right, but there's a crucial distinction with annuities that the text points out. Unlike life insurance, what happens to an annuity when you die depends entirely on its structure.
Wait, really? It's not just an automatic death benefit?
No, not at all. Some have a death benefit, sure, but others just stop completely the day you die, or they might continue only to a surviving spouse.
Oh, wow.
Yeah, a policy is only as strong as the plan behind it. You have to know what you're buying.
Okay, so let's say you do everything right. Life insurance is set, annuities are perfect, beneficiaries are locked in.
You're feeling good.
Right. But here's where it gets really interesting. There is a hidden threat that can drain these assets before you even pass away, and it's tied to Medicare.
This is such a critical point. You don't name beneficiaries on Medicare because it's a health program, not a financial account.
But the GIG script points out a huge vulnerability. Medicare doesn't cover everything. It doesn't cover long-term care or dental or vision.
Right. So if you rely solely on Medicare without any supplemental coverage, like a Medicare Advantage or a supplement plan, you are incredibly vulnerable.
Because a major medical event will just force you to drain your savings to pay the bills.
Exactly. It's a tragic irony. What is the point of meticulously naming a beneficiary on a life insurance policy if medical bills just wipe out the very estate you intended to leave behind?
You're literally burning the house down to pay the hospital.
Basically, it's a massive error in holistic planning.
Which brings us to the final wrap-up. The source outlines the 6 biggest beneficiary mistakes families make. Let's just rapid-fire these.
Let's do it.
Number 1, defaulting to your estate. This triggers that costly public probate we talked about.
Number 2, not naming a contingent or backup beneficiary.
Number 3, forgetting to update afterlife events, like divorces or births.
Number 4, naming minor children directly. Remember, use a trust.
Number 5, keeping it a secret. You have to tell trusted family where the documents actually are.
And number 6, which is probably the most common, putting it off until later.
Later sometimes never comes. But Gruene Insurance Group actually offers a really great solution for all of this.
Oh, yeah. Their review process is fantastic.
Yeah, they offer free bilingual reviews, English and Spanish, with zero pressure. They look at all your coverage. Life, annuities, Medicare, beneficiaries.
They can do it virtually or in person, right?
Yep, in person in New Braunfels or Seguin, Texas. Plus, they shop over 44 plans across 12-plus organizations, and they serve clients all across Texas, Arizona, Florida, California, Oklahoma, and West Virginia.
This raises an important question, though. With resources like that out there, why do people still procrastinate?
I mean, life gets busy, right?
It does, but it's deeper than that. Facing our mortality is just profoundly uncomfortable.
Oh, totally. Nobody wants to think about their own death.
Right. But as the source points out, dealing with this paperwork isn't about death. It's really an act of love.
I love that framing.
It is. You're ensuring that the people you care about most don't have to deal with a legal nightmare while they're actively grieving.
So it's a gift you leave them, basically, taking the burden off their shoulders.
Exactly.
So to summarize the core lesson here, your beneficiary designations are the ultimate trump card of your financial life.
They override wills, they bypass courts, and they absolutely require active, conscious updating.
Which leads me to a final question for you, listening to this right now.
Hmm?
If someone were to look at your beneficiary designations today, like right this second, what story would those documents tell about who you value in your life?
That's a powerful question.
Does that paperwork reflect your life today, or is it a ghost of your life from 10 years ago? Something to really chew on.
Definitely worth checking.
Thanks for joining us on this deep dive. Take 5 minutes today to check your accounts. We'll see you next time.